Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pick out the charts that seem to be telling us something right now, and I put them into one of three categories. Those things that are positive, those things that are negative, and then those things that we're just kind of keeping an eye on just to see if they have an impact on the S&P 500. Now, we did have an up week, but we were doing a lot better earlier in the week, and then Jerome Powell kind of rained on the parade and said, well, we're not so sure about cutting those rates in December. It may happen, it might not happen. We're not really as convicted about things as the market seems to be, and that really kind of stunned the market. They didn't like that. Now, the rate cut that happened this past week, that was fully expected and it was completed. But we have to pay attention to not only what the Fed does, we have to pay attention to what they say. And the market didn't really like what Jerome Powell had to say. Now, it was also confirmed later on in the week by other members of the committee that, yeah, we're not really too sure about that. We're a little still concerned about inflation being up closer to 3%. We're afraid that maybe the employment situation is showing some weakness. We might need to keep rates where they're at. And now the market's probably going to start forming its own scenario and pushing it out to January because they're always trying to take what is said and then develop a front run to see, okay, because the markets anticipate what they think is going to happen. Well, that got thrown a bit of a curveball this week, so we'll have to see. And it's showing some internal weakness in the S&P 500. And we have some negative things to be concerned with, but in the bigger picture, things are still looking positive. And we're asking the question, will positive seasonality matter? Now, a lot of folks probably just, November, December, strong time of the year. I'm going to put it in now. And that could still happen. We're just at the beginning. We haven't traded any days in November yet as I record this. And we'll see if some positive seasonality comes in. And it is typically, historically, a strong part of the year. And we'll see if the market can overcome some of the obstacles that we're seeing develop. Or kind of what I've been throwing out there is that maybe the market will go up. But before that, it might throw some doubt. And that's what the market likes to do, is say, okay, you're taking me for granted. You pretty much assume that I'm going to go up. Well, I just might throw a bit of a curveball and say, okay, yeah, I'll go up eventually, but I'm really going to make you think twice about when that's really going to start happening. So now we were anticipating some kind of a decline over the summer seasonally. Typically, that's what happens. Didn't happen. Now, seasonality is not automatic. And if it was, we would see 100% up or 100% down. Usually it's just what's the probability of one thing over the other actually happening. Okay, let's go through the positive side. Now, actually, it was improving. I could easily include this on the negative side. We were doing a lot better as far as sentiment, and then it started to drop down a little bit. So you could take this as more negative. The market had been getting rather extreme negative early in October, and we were coming up off of that. And we could get that back if we see one or two updates. But over the last, Wednesday, Thursday, and Friday, we saw sentiment start to get spooked a little bit. Now, this sentiment is positive. This is Investors Intelligence. It comes out once a week. And these are folks that make recommendations to buy or sell things. And an awful lot of buy signals or buy recommendations are going out right now. We're up above 4. We start paying attention to this when it gets above 3. So this is a pretty extreme reading, meaning that everybody's tending to go in the same direction at the same time. And when that happens, we look at possibly moving in the opposite direction. Now, we did have an up week. You sure wouldn't know it by looking at this chart. We started off Friday over here, and then we ended up higher over here, but there was an awful lot of bumping along the way. And things actually started off Monday and Tuesday looking pretty good. We did see some late day buying coming in Monday. That was positive. But then we saw late day selling coming in on Tuesday. And then we're just kind of humming and hawing, buying time. And then right here, this is when Jerome Powell made the statement that the market didn't really like. And even then, we bounced up from that a little bit, but it shook up the markets, and then it carried over into Thursday with a gap lower open. A lot of choppiness before this is where things really turn more negative. We saw late day selling. It's the professionals who close the market. It's the amateurs who open the market. That's why I pay attention to the close. And we saw a lot of selling going into the close. Now, then some earnings came out and it looked like, okay, we're just going to go right up here. We're going to shoot off and go to the moon. Everything is going to be wonderful. Well, that lasted the first 10 minutes the market was open. We set the high on Friday. Then we came down. Then some of the other members of the Fed, the committee, they probably came out and made their statements right about here, and it's like, oh yeah, we have to remember the Fed here. And we saw some selling coming in. We actually dropped a little bit negative, but it was more positive. We found some support and then some nice buying coming in. But then at the very end of the market, the last 20 minutes, we each one of these bars is 10 minutes. We saw some real selling, which took us back down to the daily pivot. Ended up not being all that positive of a day after all, but it did end up being a positive week, even though we gave back a lot of the gains that we're seeing. Okay, now we're still looking okay here. A little bit vulnerable. We came up to this dash line, which is a pivot point, which is already on the chart before we even get there. You can see here's the pivot points for November that are already on the chart. And we couldn't get above that. And we've been coming down. So, and I'll point this out in other charts too. This it's not as apparent here, but we are dealing with some overhead resistance that we couldn't get through at least to this point, and we're starting to come down. Now we'll see. Is that going to continue to come down? We do have some new support here right at this pivot point, which may help if we do see any kind of declines. And we have been seeing typically above average volume every day. So that means there's a lot of good participation there. Now, from a trend perspective, when you use moving averages, everything's still looking just fine. We have a 10, 20, and 30 period moving average and prices above them, and all the lines are going up. And the condition of the short-term trend still doing okay. We're slowing down a little bit, but the green line and the blue line are still going up. I use 20 periods to determine the short-term trend and the intermediate term trend. Even pulling back a little bit here, we're still above the red line and the blue line. Intermediate term trend for now is still looking positive, and we're above all the moving averages. We still have a ways to come down, even to get to the 20 period moving average. And then if we do break below that, we'll be watching the 50 period moving average. Now, since we came up out of the lows in April, most any pullbacks that we've seen have been around the 20 period moving average. We hung down here for a little while, but we stayed above the 50 period moving averages here. And then we finally were able to break to the upside. So this is pretty important stuff. And the market will be watching this. So we'll see if this provides some kind of support. But now we're not really far away from the 20 period moving average. It's still looking pretty healthy here. We're coming in at 84. When this starts to look extreme is when we get a reading of 100. But we are starting again to be far away from the 50 period moving average. That's intermediate term. We're getting this is extreme when we get above 200. Now we're at 201 here. So it's like, oh yeah, big deal. But we still pay attention to this anyway, that we are kind of far away from that 50 period moving average. And we're also still more than 10% above the 200-day simple moving average. I've been bringing this up for quite a while now. We're 11.92% above that. And other times when we get a little overextended above this 10% level, that typically will lead to more significant declines. And we're just watching that. We were watching it as we were coming into the fall here. Then we finally broke below it a little bit. We had a big down day in the middle of October. We finally bounced up from that. And so we'll see. Is this getting up to that point again? It could still go higher than where it's at right now. There's really no magic level here. We just kind of watch it once it goes above 10%. Now, this is a monthly chart, and I could show this because we just finished October on Friday. This is a monthly chart of the TTM squeeze, which is a momentum oscillator. It's popular with some folks. Now, we were looking more negative going into the end of 2024. It was dark blue and going down. Now, the last couple of months, it's turned to the lighter blue, and it's starting to go back up. So this is looking more positive longer term. And we did have enough of an upward move here to draw in some new X's. Now, this is a weekly point and figure chart. We had some X's on the daily side earlier in the week, but then nothing later on as the market was under a bit of pressure. But this is for the week, and this is still looking good. We got up just about to that 6,900 level, even a little bit above it, but we're below it right now. But this is still looking positive from a point and figure perspective. And we're still below 20, even though the VIX is creeping up a little bit. We're going a little bit above the moving average with the line chart as well as the bar chart. And so we only get really concerned when we start to get above 20. If we can drop down below 17, that would be even more positive. And we're still looking good overall here. Risk on to risk off ratio is still going up. That's positive there. And we're still hanging in there. The advanced decline line based on price and volume taking a bit of a hit. It actually ticked up a little bit on Friday, but it's still looking good longer term here. We're still above this advancing moving average. Now, we're in a non-trending environment when we look at the short term and intermediate term on the daily side, and we're still positive here. We still see the green line, even though it's coming down, is still above the red line. But this signals that the short term, we're not trending currently, and we're not trending in the intermediate term, but we're still defaulting to positive because the green line is above the red line. And on the weekly side, we are showing a little bit of an improvement. We're above the moving average, but we haven't crossed back above 20. And to have this be a confirmed trend, we cross above 20, but now it's strengthening because it's above the moving average and the green line's going up as the red line's going down. So even though this bar doesn't look all that good, we opened and closed just about at the same spot. This is a weekly bar. Here, we're still maintaining this series of higher highs and higher lows, at least to this point. In the bigger picture, we're looking a little bit more vulnerable on the daily side. And we're positive here with the daily parabolic SAR and the weekly parabolic SAR. Now, momentum is still positive. Short term, we have two oscillators, slope and TSI, rolling over a bit with the TSI, but still positive, hasn't crossed below the moving average. Rolling over a bit here with our three intermediate term, and we're still looking positive with the two long-term oscillators. And we're positive with the daily Copic curve. We're negative on the weekly side. I don't have that chart here. And we're positive with the vortex. I count this as a primary indicator. And we're seeing a little bit of separation here. We were really chopping around here for quite a while. Now we see the green line trying to break above and the red line going down. So it's showing a bit more conviction. But that was mainly picking up what we saw earlier in the week. If we still, come down here, we're looking a little vulnerable with lower highs and lower lows. That continues to go down. We'll be watching the 20 period moving averages first, but this might take a bit of a hit as well. Now, depending on your perspective, this is either positive or negative. Growth to value ratios. The Qs to S&P looking really solid there. Discretionary S&P, not so much. It's improving and it came up, but it's still below a declining moving average. But then when we look at large cap growth to value, even though it came down on Thursday and Friday, this ratio is still looking pretty good. And with the large caps looking pretty solid, but we're coming back up to the moving average with the mid caps. Now the small caps, that's looking pretty strong. But the index isn't really moving. It's kind of been range bound lately. And this is still positive. We're still going down with staples to S&P. And when that's going down, that's more positive. That means the S&P is outperforming more defensive staples. And we're coming up here. We didn't quite get up to this R2 pivot point. And again, we had the open and the close not all that far from each other with the weekly bar, even though we were up 0.71% on the week. But we're still looking okay longer term. Higher highs, higher lows. The weekly bars are healthy for right now. And when we look at those stocks in the S&P above their 200-day simple moving average, we actually turned up a little bit on Friday, and we're still above 50. That's positive. It's the other moving averages. I'll get to these over on the negative side. And we're just coming off of recent highs with the semiconductor index, and then the SMH semiconductor ETF also just recently set all-time highs, coming down a bit here, but still above the rainbow. This is also the SMH semiconductor ETF. And we're still going up with the tech sector actually doing well, but the semis are doing even better. And we like it when this ratio is going up. We like when tech is doing good, but we like when semis are doing even better than tech. And when this ratio is going up, that means semis are outperforming. So that's still holding up for right now. And we look at semiconductors to the Dow. That's doing really well here. High beta to low beta, a little bit of a jolt up here, but we are going up and we have been going up. And this is what's been leading the market higher as we came out of those April lows. And this ratio going down is positive. Value is underperforming tech. Now the Dow just set recent all-time highs here, but it's just kind of drifting down a little bit. It's still positive because we're above the 50-period moving average and we're still in an uptrend. And the Nasdaq hitting this pivot point over here, which is overhead resistance, and starting to come down a little bit here, even though it was a little bit stronger in Friday's session. We'll keep an eye on this. The Nasdaq and Nasdaq 100, they seem to pay attention to these pivot points a lot more. Nasdaq 100 was able to get a little bit above the pivot point and then we closed down below it, but it's still positive overall. We're still positive, but seeing a little bit of weakness coming in with the momentum for the Nasdaq 100. This is a weekly chart of the QQQs, the Nasdaq 100, just looking pretty solid there. Another weekly chart, we're well above this trend line going back to 2009. Small caps though, just kind of blah, 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 blah. Just bouncing around with the S&P 600 small cap index, looking a little bit better here with the Russell 2000 small cap index. So not great, not terrible, but some recent weakness coming down here. Small caps like it when interest rates are going down because they have to borrow a lot of money. Mid caps like that too. And that didn't go over too well for the small caps when Jerome Powell said, we're not so sure about December, because the market had pretty much been figuring that into the equation. And he pretty much removed that. And so that's why the markets got a little spooked. All right, but you look at the growth to value ratio for the small caps, doing really well here. But the index isn't doing all that much. In fact, we're seeing some recent weakness as this ratio has been going up. Mid cap growth to value, again, this is the worst performing index right now, the mid caps, but they have one of the healthier looking growth to value ratios. And coming down a little bit, but still looking pretty good. This is growth to value, bigger picture here. That's still holding up. And the Wilshire 5000 broad market just set a recent all-time high and just not too far off of those highs and a little bit off of the highs here with the total U.S. stock ETF. The FANG index, it was up a little bit on Friday and it set highs earlier in the week. These are the really big stocks. That's still looking okay there. The Qs, the NASDAQ 100 to small caps, is still well above this blue line, and now the ratio is going back up. And this ratio is going down. Staples to tech, it's more positive for the market when this ratio declines. And now the market is not really anticipating that we're going to go into a recession. We're still well above the rainbow. That's what we mean by a soft landing here. So even though we pulled back a little bit, the market hasn't switched its overall big picture view of whether we're going to head into a recession or not. This is that same chart, but inverted. This just shows how bonds continue to underperform stocks. And we look at, and you're going to see a lot of the same things here, and that's by design. We want to see the same things as we look through this next series of charts. A broad market measure to 3 to 7 year bonds coming back, but still above the rainbow. Tech to 3 to 7 year bonds, still above the rainbow. QQQs to 3 to 7 year bonds, still above the rainbow. The NASDAQ 100 to Dow, still going up here. Growth is outperforming the ultimate value, which are the blue chips. That's the Dow, even though there's some growth stocks in the Dow, in the index. And we are positive here with the daily special K chart. We're also positive with the weekly special K chart. So longer term, we're still positive that way. And then seasonality is positive. No matter how you look at it, November does really well. The only other month that's kind of compared to that would be July. You know, sell in May and go away. Well, you missed July, and there's positive seasonality there. But whether you look, you go back to 1950, you go back to the last 20 years, 10 years, or just post-election years, we have positive seasonality for November. It does drift off a little bit here in December, but there's still some positive seasonality there. And this is also just looking at post-election cycles. And this is positive seasonality going into the end of the year. Now we switch over to the negative side. And here is that same chart again. Isn't that nice? So I guess here you could put it a little more negative since we dropped. And then we're not really showing any real strength. We were looking better here with our intraday growth to value. This is showing both of them. Values in red, growth is in blue. We were looking a lot stronger here. Now, we were a little bit concerned because the red line's above the blue line. We would like to see the blue line growth above the red line, but the fact that they were both going up was positive in and of itself. Now we're seeing them drifting down just a little bit here. This is also stalling out after it was looking pretty solid. This is growth to value for the S&P. It was really going up, breaking out of this recent range that we've been in, above all the moving averages, now starting to come back down slightly. And this, we've been watching this since last summer. Through August, we dropped below the 50 period moving average, and we just cannot seem to get above that. Now, we're still positive in the longer term, but it's like, okay, if this was a more positive environment, this ratio would be going up and it'd be well above its 50-day moving average. So I have it as negative, just it's positive in the longer term, but we've been watching this now for quite some time in the shorter term. And this red line's going up here. Now, when we started coming up out of the April lows, this red line was coming down. This is the VIX to move ratio, stock volatility to bond volatility. And we were really coming down with the line. And then we started to switch and go up. Now, it hasn't really presented itself all that much. It's just something that we're keeping an eye on. It's just that we're seeing a change in character. And that's why this is more on the positive side because we're starting to, this means that stock volatility is increasing when you try to compare it to bond volatility. And that could, volatility usually means we're going down. And we're seeing some weakness here, not full-blown negative, more in the short term. We saw a real drop-off in the new highs with the S&P and a bit of an expansion of the new lows, even though it contracted by Friday. But we're going down with the 5-day moving average chart and the 10-day moving average chart. So this is looking a little vulnerable right now. And our advanced decline oscillator, it was showing a lot of strength. Now it's coming back. It hasn't quite turned negative. It's at -1, so it's officially negative when it drops below zero here. But it's not, we were range bound here for quite a while, and then it looked like, well, we're finally breaking out. Well, that kind of stopped later in the week. And now our three smart money indicators, they're all negative. Now, positive in the short term, unless we drop below the red line. That's going to turn this longer term negative. But we're below the moving average here with the boom indicator, which is a modified MACD. And that just tries to pick up shorter term movement with the indicator itself. And so this is negative right here. Smart money indicator number 2, the Chaikin money flow, we're declining with the histogram. Now we bounced up a little bit on Friday, but not enough to keep the red line from continuing to go down. So that's still negative, and we continue to drop off here with the Chaikin oscillator. This is smart money indicator number 3. And we're below zero, even though we ticked up a little bit with the S&P McClellan oscillator. When that's below zero, the summation index based on price is going down. We're slowing down a little bit, but we're still declining here with the summation index based on volume. That's negative as well. And we ticked up here, but we're still below zero with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume for the NYSE. We're still below 50 with those stocks in the S&P above their 20-period moving average. The 200-period moving average, that was over on the positive side. This is shorter term. This is the 20-period moving averages, and we're still below 50 here, and that's more negative in the short term. We're also below 50 and declining with those stocks above their 50-period moving average. That suggests a bit of vulnerability to the intermediate term. And you notice here a series of lower highs. We couldn't break, we haven't been able to break out of that. Going back to July, that's when this topped out, and we've just been kind of drifting down ever since then. It hasn't really reflected itself in price, but we just want to be aware of this. This is showing that as the S&P has been going up, those stocks that are showing intermediate term strength has actually been going down. And we're still below 50 with those stocks above their 100-period moving averages. Okay, and then the Swindon trading oscillator, declining both based on price and volume. Now we're positive here. The reason this is on the negative side is when we break it out based on price and volume, we've dropped below the moving average with the PMO, but the PMO itself is still positive. That's why these other indicators are on here, because we sometimes this will lead what happens with the PMO itself. So we're seeing a little bit more weakness based on price. We're dropping, but we haven't crossed below the moving average based on volume. Then we look at all the PMOs inside of the S&P, And we ticked up a little bit on Friday with the PMOs that are rising. These are inside all the stocks inside the S&P, but still below 50. A little bit of a plateau here with the buy signals, but we're still below 50 there, and we're continuing to decline with the PMOs that are above zero. This is still showing some weakness developing in the S&P. We need all three of these to get back above 50 to show that they're gaining some strength. And we're declining with the bullish percent index. We're below the moving average and declining. Now we're just barely above 50. We're at 50.2. This is going to be even more negative if we drop below 50. This just shows that the number of buy signals are going away and the number of sell signals inside the S&P are starting to pick up. We're also seeing a decline, but I still count this as positive with the NYSE bullish percent index. It's positive because it's above 50, and we're declining, but still above 50 with the NASDAQ 100 bullish percent index. And seeing some weakness with the advanced decline line here, NYSE common stock. Now it ticked up on Friday, but it's still below the moving average. We're right on the moving average with the S&P. A little bit of a tick up with the mid caps, but still below the moving average, and flat and below the moving average with the small caps. And this is a long-term chart here. This is the Zohorchak method. Good old Midwestern name there. And it was actually improving. We were at a minus, we got all the way down to a minus 10. Then we got up to a minus 6. We're at a minus 4. So it is improving, but it's still negative. It won't be positive until it crosses back above zero. This is a very long-term chart, though, and we're not really sure when this is going to change. And then looking at the discretionary to staples, we're just hanging out around the 50-period moving average. We're still in an uptrend, but not showing some real convicted strength right now. And small caps continue to underperform the S&P. That just hasn't changed. Mid caps are dropping below their 50-period moving average. Now, the financial sector, the reason it's negative is because it's underperforming the S&P, but we're spending a lot of time underneath this 50-period moving average, even though we're still in an uptrend here. This is what's causing some concern. And this goes back to last spring. We started to see the financial sector underperforming. It's like, okay, what news hasn't broke yet that the market is anticipating about the financial sector? Is there going to be some bank problems? Is there other issues in the financial sector that we don't know about? Or is this just some kind of an anomaly that's gone on for a long time and eventually will turn and go back up? We don't know that yet, but we've been watching this for quite some time without really any background knowledge about why this is actually happening. But the market is anticipating this, and that's why the financial sector is underperforming. Now, home construction, not doing so good. Coming down to the bottom end of the rainbow. They didn't like that Powell came out and said, we're probably not going to cut. Well, he didn't say that. He said the rate cuts in December are not a foregone conclusion. But the market took it as, oh my gosh, we need to freak out. And freak out they did. And we'll see if there's any more freak out left to do. And we've come back down here to the bottom end of the rainbow with this ratio to the 3 to 7 year bond. Then those things that we're just keeping an eye on. We want to watch volume. It's been above average, but tapering off just a little bit as we finished out the week. Now this, I treat this as kind of a novelty chart because sometimes it's kind of cool and other times it's like totally irrelevant to what's happening. But this is predicting on the daily side a reversal because we were going up and the criteria is we have to cross above the red dash line, the blue line, and then we have to come back down and cross back below the red dash line again. And then whatever the market was doing to make these signals happen, this is suggesting that there'll be a reversal. And so, okay, all right, we'll just see. So far it looks like we're seeing a little bit of weakness here. We'll see if there's any more follow through. Now, if that wasn't crazy enough, we have a Pring bottom fisher buy signal. When we cross above the red line, that's a buy signal. So another novelty chart. Again, it's no disrespect to the people that created these. It's just I don't use these in isolation. But we have a sell signal on one side and a buy signal over here. We're just watching this. That's why it's not on the positive or negative side. And we want to watch the 10-year yield. We had dropped below 4%. And now we're back up to 4.1%. And we did that pretty quickly. And it was more positive for the market when we were coming down. Small caps were doing better and everybody was a little bit happier. And then everything kind of shifted midweek. And now this is what's strange, though. is the 10-year yield was coming down, knowing that the Fed was going to cut rates. And then after they cut rates, you'd think it would at least stabilize, if not continue to go down. No, it went back up. And we've been seeing that over the last couple of times when the Fed started to come in and cut rates. This chart doesn't go back long enough to show that, but we have been seeing that. 10-year yield going down, Fed cuts rates, and then it starts to go back up. Now, if this keeps going back up, that could put some pressure on stocks. And then we want to watch the spread between risky and not as risky bonds. Not really a problem right now. If this really starts to drop, yeah, that's going to be a concern. But if it's staying up around where it's at right now, not really causing any concern at this point. And we're not seeing really any concern from the market as far as inflation and interest rates. Still going down with this ratio. That means the market's not concerned. And we're going sideways with this ratio. And we're continuing to go down with this other ratio. So no matter what YouTube or Rumble videos you watch that say inflation is going to just blast through the roof, the market's not anticipating that at this time. And then Eurozone, these are European stocks. They're still outperforming American bonds. And we do a ratio just kind of out of fun to see how Europe and the US are interacting with each other. And we want to watch the S&P to utilities ratio, really choppy. Can't seem to get any real sustained conviction from this right now. And we're at the 60 range with oil. And we're still in a downtrend here. We mainly watch this for geopolitical reasons. And then we watch some different ratios here. Now we're seeing a bit of a disconnect when we look at the weighted version of discretionary to staples. And this is going up and looking pretty solid. Well, you get Amazon and Tesla having good days, and this ratio does go up. But then when you look at the equal weight version of that, it's not really showing any follow through. We like these two charts to confirm each other, and they're not right now. We're still looking okay with tech to utilities. Growth is outperforming value here. Biotech is outperforming healthcare. That's doing quite well. And kind of after declining, we tried to bounce back up, and now we're coming back down. When we look at hotels to utilities, that's discretionary to value, unless you consider utilities a growth area because of AI and electric vehicles and everything. And then we are just coming off of recent all-time highs with the semiconductors. That's looking pretty good. But the home builders, as I showed earlier, they're not doing all that great right now. The transports are going sideways. We're seeing some weakness in retail and also a bit of a drop off here with the regional banks. These are the smaller banks. We would like to see all of these going up. That would show signs of a stronger market. And we're coming down here. Gold has been pulling back. The S&P has been going up, at least earlier in the week, and it had an up week. And that's why we're seeing this ratio coming down. And we're just about up to this resistance level, and that's about where we topped out and been coming down. We just watch this just to see how gold and stocks are interacting with each other. Pretty much going sideways with the US to international ratio and drifting off a bit when we look at momentum stocks, comparing it to the S&P. So we had been range bound here, but we're seeing momentum stocks, at least in the short term, starting to underperform. And now we're in a higher range. When we look at emerging markets versus developed markets, we were in a lower range, and we got kicked up to a higher range, and we've really been going sideways overall. And we want to watch the dollar, especially if it breaks above 100. Notice how it came right up here in August and then hit that 100 level, and then bam, it went down. And that was helping the market to go up. Well, if this goes above 100 and keeps going, that might put some pressure on stocks. And then here's the German DAX. Just that's the biggest stock market in the EU, so we just keep an eye on it. And it's gone sideways right now. And then we do a ratio, and this is going up. That means US stocks are outperforming German stocks. And here are the pivot points for Monday's session. They're available on the website. They're available on the YouTube community tab. I can't put them on Rumble, but this is good to know these things ahead of time because we don't get much advanced information. And what advanced information we do get, we like to use it. And a lot of the algorithm and trading, the computers that trade instead of people, they have these programmed into them and they act as support and resistance levels. And we are in a period of positive seasonality. We're in the first half of November, which does pretty well. Second half of November, going back to 1950, also does pretty good. And now we have this thing called the Hindenburg Omen. And I have to say, I follow one or two perma bears because I do the opposite of whatever they say. If they say we're going down, man, we're setting new all-time highs. Well, one of the perma bears, I don't subscribe to anything, but I get emails. And they're even doubting a little bit of the Hindenburg Omen here. And that's making me go, hmm. Now, I ignored this for years because I learned about this from a perma bear. And I'm not a perma bear, I'm not a perma bull. I'm a perma realist. Markets go up about 70% of the time. They do go down about 30% of the time. We just want to be on the right side of what's happening. We're not here to say doom or gloom or be eternal optimists. We have to be realistic about things. And there are cycles, and there are strong cycles and weak cycles and negative cycles and positive cycles. Well, since I learned about this from a perma bear, I kind of dismissed it. Well, and then here's the criteria if you're ever interested in that. This is the theory that goes in. And I don't even know this perma bear was saying that last spring there was a Hindenburg omen. I'm not saying one. I'll show you the chart here in a moment. There wasn't one. And that's what I get really gun shy of these folks because even if we're close, even if we're within breathing distance, they count it as a done deal. And it's like, no, doesn't always work that way. There's rules that we have to follow here. Don't try scaring people, just have them freak out. And don't always, you know, go on the negative side of things. So anyway, now there was a little spike here earlier on, but this is one spike. It came in March, but it was not confirmed. We have to get another spike for that to be confirmed. See, to say that this is an on the books, put a fork in it, the market's going to decline heavily, that's not true. Okay, now we're starting to see some spikes here. We had the initial spike on October 10th. Now we have it confirmed on October 29th, and it's still up here. So we had it confirmed both Thursday, actually Wednesday and Thursday. There's a 1 day lag. The last time this chart was updated was Thursday, October 30th. The more spikes we get, the more we have to pay attention to this. Because if you look right before the COVID crash, we were at all-time highs right here, and then we just fell through the floor. Well, we started to see confirmation from this. And then at the end of 2021, we ended up going into the bear market of 2022. We saw a series of spikes. Well, if we start getting a series of spikes here, we have to respect that. Doesn't mean it's going to happen because even a lot of people say, well, this is only, you're right, 23% or 25% of the time. Yeah, when you take one spike alone, but when you see a lot of them together, you need to pay more attention to that. And even then, it's not an absolute. That's why we look at more than just one thing and a lot of different ways of analyzing the market. So thank you. I hope you're having a wonderful weekend. I hope you're a Dodgers fan because ended up winning the World Series, even though it looked like the Blue Jays were going to take it. And if you're into baseball and you like that the Dodgers won, well, good for you. And now we'll just hang on until the season starts again next spring.